Disability income protection is the coverage that matters most to solo coaches and the one they are least likely to have. And the asymmetry between those two facts is the most expensive gap I see in founding year practices. Life insurance gets the attention because death is dramatic and culturally familiar. Disability gets skipped because it is harder to imagine and the math is less commonly run. But the probability numbers tell a different story than the cultural attention does. And the income gap most coaches have when they actually run, the calculation is materially larger than they expect. If you cannot work, there is no practice, no revenue from clients, no way to cover business expenses, no path to recovery through the business itself, because the business runs on you doing the work. Your income is the asset. Disability insurance protects the asset. That framing matters more than it sounds. The policy is not a luxury layered on top of healthy revenue. It is the floor that keeps the practice from disappearing entirely when the human cannot function. For a solo coach with no employer short-term disability, no sick days, and no one to cover the practice during recovery, this is the foundational protective coverage. A 40-year-old worker is several times more likely to experience a disabling illness or injury before 65 than to die before 65. The statistic is the one I want you to sit with, because the cultural emphasis on life insurance has the proportions backwards relative to actual probability. Life insurance protects your dependents from your death. Disability insurance protects you from your inability to earn. For a solo earner whose income is the only revenue source for the practice and possibly for the household, the disability scenario is statistically more likely and operationally more consequential. The asymmetry between attention and risk is the gap most founding budgets carry. The own occupation versus any occupation distinction is the single most load-bearing item in the entire policy, and it is the term that determines whether the coverage actually pays in a real scenario. Own occupation coverage pays when you cannot perform the specific duties of your work as a coach: cognitive injury after a concussion, voice loss, chronic fatigue that prevents the focused attention coaching requires. Any occupation coverage pays only when you cannot perform any work at all, which sets the qualification bar at can you flip burgers and produces denied claims for most disability scenarios a coach would actually face. Own occupation is worth the higher premium. Any occupation is cheaper and worth much less. The elimination period is the waiting period between when the disability happens and when benefits start paying, and it pairs directly with your cash runway from Module 16.3. Common options are 30, 60, 90, or 180 days. Longer elimination period equals lower premium. The trade-off is whether your existing operating reserves can cover the gap during the wait. With 3 to 6 months of operating reserves built up, a 90-day elimination period is sustainable and the premium drops meaningfully. With a 30-day reserve, a 90-day elimination period leaves a 60-day gap of uncovered expenses that you have to plan for. The decision is not the policy alone. It is the pairing. The benefit period is how long benefits actually pay once they start, and the choice is between a 2-year benefit and a to age 65 benefit. The 2-year benefit pays during recovery from a typical disabling event, a surgery, a serious illness, a recovery period with a defined endpoint. It leaves you completely unprotected if the disability turns out to be permanent or long-term, which is the exact scenario the policy is supposed to handle. The to age 65 benefit is the right anchor for a solo earner, because the catastrophic scenario is the one that actually breaks the practice, and the price difference is rarely the factor that makes the decision. The income gap calculation is the move that turns the policy from an abstract decision into a quantified number, and you walk into the broker call with the number instead of asking the broker to discover it for you. Monthly personal expenses plus monthly business fixed costs, software, professional development, the insurance premiums themselves, plus your monthly reserve contribution target, plus your monthly insurance premiums. That sum is your monthly income need in a disability scenario. Your current disability benefit, if you have any coverage at all, subtracts from the need. The difference is the gap. The gap is what you're actually uncovered for, and the gap is what the policy has to close. The worked example I want to walk you through is one of the patterns I see most often, because most coaches with disability coverage bought what they could afford at the time without running the calculation. $8,000 a month in net income, personal expenses of $4,500, business fixed costs of $800. She bought a $3,000 monthly benefit because that was the premium that fit the budget when she set up the policy. Her actual monthly need is $5,300. Her gap is $2,300 a month. A 12-month disability creates $27,600 in unmet expenses on top of whatever drained the reserves during the elimination period. Run the gap calculation against your real numbers before the broker call, and walk in with the gap as the opening number, rather than as something the broker has to discover from you. Complete the disability coverage decision sheet. Set the elimination period against your current cash runway from Module 16.3. Do not buy a 30-day elimination period if a 90-day period is sustainable, because the premium difference is real and the reserves close the gap. Set the benefit period to age 65 unless there is a specific reason to shorten it. Get quotes for own occupation coverage only. Any occupation quotes are a different product and not worth comparing against.